It depends on what stage of the game that you're in. If you're a newer investor and you need income, you need as much income as possible, whether it's from your W-2 or your rental properties, you want to try to depreciate as much as possible. Why? Because you still get the expense, you're still saving money on taxes, and you get to add that back to your income. Hey, what's going on, everyone? Welcome back to the Learn Like a CPA show. I'm your host, Ryan Baking. Today, I want to talk about the number one thing that prevents real estate investors from scaling their portfolio, leaving their W-2 jobs, and achieving any goal financially. And it's number one most important thing: protect your debt to income ratio. The most important thing that you can do as a real estate investor is protect your DTI. And it is also the number one thing that I see that prevents most real estate investors from scaling. So I just want to lay some groundwork here of how to quickly calculate your debt to income. Okay, this is not tried and true, it's not fast, so do not hold me to it. But I just want to say that on average, if you take your yearly income and you multiply it by 5, that's about the total amount of outstanding loans that you can have at a time. Again, that's not a concrete example, that's not a definition. Each lender is going to have their own requirements, but if I make $100,000 a year, I'm going to be able to have about $500,000 of outstanding loans. And if my primary residence is, say, $200,000, well, that leaves me with a borrowing power of $300,000, for example. Now, what helps this? Well, other income. Like if we have side hustle income, a couple years of tax returns on that. If we have rental properties that are in service already, we can count the income from those properties towards our debt to income. And that's why it's super, super important that you have an intimate relationship with your lender, intimate in terms of you're always communicating with them on a probably a monthly basis, quarterly basis, to figure out what your borrowing power is. The reason why I'm filming this podcast in the first place is I got off the phone with 2 clients earlier today who are having debt to income issues, potentially debt to income issues. One person's quitting their W-2 job at the middle of this year. The other person has certain expenses, deductions that they have on their tax return that's giving them lending issues. So understanding the importance of kind of like what goes into your debt to income, what are things you can add, what are things that you have to take out, all that stuff is important. Understanding the timing of when you buy and close on properties is also equally important, okay? Because let's say, for example, if I have let's say it's October, and I buy a property in October, I spend a month renovating it, getting it finished, staging it, and I don't go live till December. Well, the problem with that is if I want to end up buying another property the next year, that property that I bought in October, but I didn't actually place into service until December, that's showing up on my debt to income. When they pull my credit, when they pull my net worth statement, like they're going to see that loan. And because it went live in December, it's not necessarily the most revenue generating thing. Now we're going to get into a little bit about how short-term rentals are counted different than long-term rentals. I'll teach you guys a little bit about that. But think about that for a second. The timing of when you go live on a property in terms of your debt to income is super important. I want to also throw this out there. A lot of investors don't think about the fact that let's say you and your spouse are both working W-2 jobs, you have a really healthy income, let's call it $300K total. And so then you listen to this podcast and then you're like, okay, great, we can have $1.5 million worth of loans. Does that mean you get $1.5 million worth of loans? Maybe not, if your income is $300K. But what happens if you do get $1.5 million in loans and then one of the spouses quits their job? Well, you lose banking power, you lose bankability. So think about these things before you go to do something, because how your debt to income impacts you, it means the world for real estate investors. Short-term rentals versus long-term rentals when it comes to rent, okay? Now, I just want to throw this out there. Long-term rentals are pretty straightforward. In fact, for long-term rentals, all you have to do is have a lease in hand for them to count your long-term rent with your income. Okay, so I don't have to have a year or 2 years tax returns filed in order to count long-term rental income. I literally just need to have the lease, the contract in hand that shows that this property is rented out. So pretty straightforward and easy if you're a long-term rental investor. Short-term rentals, on the other hand, they get a little trickier. Now, the common misconception in the industry is that in order for a short-term rental to count, you need to have a full year's worth of tax returns filed for that. And I'm not talking just a tax return filed. I'm talking you need to have it rented out for an entire year for one full year. And that is when a lot of lenders started doing short-term rental loans, that was a misconception that a lot of them had. When in fact, you just need to have one tax return filed, and it doesn't have to be for the full year. It can be 3 months, 4 months, half a year. Ideally, it's at least 3 months, okay? Because the client that I was telling you guys about, we just ran into an issue because they only had 1 or 2 months rented on these properties. So they had a bunch of startup costs, setup costs that were counting against them, even though they were only one-time expenses that we know of. But when you go live, super important. But I just want to mention that for short-term rentals, you do not have to have a full year. You just have to have one filed tax return showing that property. And this is what's important, guys, if you're a short-term rental investor. The first thing that's important on your tax return is that the property is adequately marked as a short-term rental. If you go to Schedule E of your tax return, there are certain identification numbers for different properties. Whether you have a single-family home, a multifamily home, a commercial property, a short-term rental, they all have different markers. And a lot of CPAs, a lot of accountants that don't know any better, they think that your short-term rental in the Smokies is a single-family home. Well, yes, it is a single-family home, but it's not being used as a single-family home rental. It's being used as a short-term rental. So make sure that it's marked 3 for short-term rental as opposed to 1 for single-family home. Okay. The next most important thing is that the days rented is accurate. See, by default, most CPAs or most accountants will just put 365 days rented, and that's false. And here's how that can come back to hurt you. Because let's say, for example, you go live on a property in August to the end of the year, or let's just say July to the end of the year to keep it a little bit easier. July to the end of the year is 180 days, give or take. But if I have $50,000 of revenue, and I'm not the smartest person, so I'm going to use a calculator here. But if I have $50,000 of revenue and I divide that by 12 months, that's gonna show that I'm only making $4,100 a month, right? Annualized over 12 months. But it's not rented out for 12 months. It's only rented out for 6 months. So what I really need to be doing is taking that $50,000 of rent, dividing it by 6. I get $8,300 a month. That I'm able to annualize that over a year. And so really it's $100,000 of income for the year and not only $50,000. So very important that your CPA knows that. Your CPA should know, number 1, mark it as a short-term rental. Number 2, you're putting the actual days that the property was rented out, not 365 days. It's not the total days that it was available for rent. This is the number of days that the property was actually rented out for. The next thing I want to talk a little bit about is depreciation versus repair/improvements, okay? Now, before we get into this, actually, it's really important to understand what do lenders typically add back and what do lenders typically not add back. So your standard add backs, if you're doing a Fannie or a Freddie loan, your lender is going to be adding back things like mortgage interest, property taxes, insurance, HOA fees, and of course, depreciation, okay? So for those of you who are doing accelerated depreciation or cost seg studies, that will not impact your ability to borrow money because your lender should be adding back the depreciation to your income, okay? So property taxes, mortgage interest, HOA fees, property insurance, depreciation, all these things are going to be add backs to your income. Now, a more sneaky thing that's out there is the difference between depreciation and writing something off using depreciation and writing something off as a repair and maintenance expense. You see, when you depreciate assets, furniture, countertops, millwork, flooring, when you depreciate assets, you get the tax deduction for that. But you get to also add it back to your income, remember? And that's the important part for those of you who are kind of just starting out. Maybe you got 2 or 3 properties, 1 or 2 properties, and you need all the income that you can get. You really want to be depreciating as much stuff as possible that you can. You don't, on the other hand, want to be writing off a lot of stuff as expenses, because there's a lot of stuff that you can also write off as an expense, like a furniture, you're replacing a countertop, or you're replacing a thing here and there. That's a repair and improvement or a repair and maintenance. And it can be immediately written off on your tax return, and it doesn't have to be depreciated. So what are the pros to that? Well, the pros to that is, remember, there's this thing called depreciation recapture. Well, if you are writing everything off as a repair and maintenance expense, well, then you don't have to pay the depreciation recapture somewhere down the line, right? But repairs and maintenance don't get added back to your rental income. They do not get added back because that's an expense of maintaining and ongoing the property, and it can be expected for years to come. So think about that. And this is the easiest example that I can give most of you, and this is what I give most of my clients, is that it depends on what stage of the game that you're in. Okay, if you're a newer investor and you need income, you need as much income as possible, whether it's from your W-2 or your rental properties, you want to try to depreciate as much as possible. Why? Because you still get the expense, you're still saving money on taxes, and you get to add that back to your income. However, if you're on the other side of the fence, maybe you're like me, like I already got 4 or 5 properties, I got a healthy income, I can afford to write off as much as possible now, and then I don't have to pay that depreciation recapture down the road. So it really kind of just depends on what journey or stage you're at in your investing game, whether or not you depreciate something or you write it off as a repair and maintenance expense. So I hope I was able to clarify that a little bit more. Now, the last thing I want to talk about, and maybe this needs to be an entire podcast on itself, is big thing that I'm seeing a lot lately is people's ability to access capital in projects is becoming uber important. Okay. We onboard anywhere between 20 to 30 new clients a month for our service called Tax Strategy 365. We got over 250 real estate investors in there. One of the first things we do is we have you fill out what's called a net worth statement. And the net worth statement is going to outline all your properties, all your 401ks, IRAs, where do you have cash? And here's what I found that's the most shocking is we work with a lot of people who have a $1.5 to $2 million net worth, let's say. But if I ask that person to go out and take out $30,000 out of a bank account by tomorrow, they couldn't do it. And the problem is most real estate investors aren't liquid enough in their portfolios, okay? Because they have a good net worth, but it's all tied up in retirement accounts, which we know we can't access those until we're 59 unless we want to pay penalties and taxes, or they're tied up in real estate deals. Now, I know you're saying, Ryan, well, it's real estate. Of course, the money's going to be tied up. But what I want to see from people is I want you to have 10 to 15% of your net worth should be in cash or securities, something where you can access by the end of this week if you needed to. Okay, and what I mean by that is either a cash, so like a high yield savings account, a checking account, or one of my personal favorites, and if you listen to the podcast that I talk a lot about, is the taxable brokerage account. Okay, so I want you to have 10 to 15% of your overall net worth in cash and or in a taxable brokerage account at any given time. So if I have a $2 million net worth, I want to see you as an investor, I want to see you have about $300,000 liquid that you're able to access, okay? I'm not talking 401ks, I'm not talking real estate, I'm talking $300,000 that you're able to access by the end of this week, God forbid if you have to. Thanks everyone for listening. We talked about the importance of debt to income. We talked about the difference between short-term rental, long-term rental. We talked about depreciation, repairs, and improvements. We talked about how I want to see most of you guys have about 10 to 15% of your net worth in cash or a taxable brokerage account. If you're interested in becoming a client, like I said, we take on about 20 to 30 new people a month. We review your prior year tax returns. We onboard you. We have you fill out the net worth statement. We work with you for an entire year to put your tax strategy, put your game plan in place. Go over to taxstrategy365.com to apply to become a client today, or check out the free Facebook group, Tax Strategies for Real Estate Investors. Got over 10,500 real estate investors in that community engaging daily. And that's going to be it. Thanks for tuning in. See you guys on the next episode.